All right, recording is in progress. Good morning, everyone. Thanks for joining us. Thank you to Kevin Young from Guild Mortgage for joining us. We were already having some good conversations pre-recording, so I figure I better get this kicked off before we miss any good info. We're going to be all over the board today, which is kind of on purpose. Like, we want to cover what you want to cover. I mean, Kevin's got he's got information to fill an 8-hour class if we wanted, so we may have to do some more of these. Kevin's willing to meet with any of you individually, talk to you on the phone, whatever. We can get together in some of the offices if if the time and circumstances allow. I think people have gotten used to meeting via Zoom a little bit, and it is super convenient. And I am recording this for those who couldn't make it today. But before we even get started, I don't want to forget anything in the chat. Obviously, throw some questions in the chat if you have them, and I'll keep an eye on that. We've already got one in there, so I want to make sure I cover that. I don't know if you can see it, Kevin, but April's wondering if you're offering I assume she means like a proof that they can pay the escalation or appraisal gap. We were talking about that a little bit. Yeah, how to agents.
Well, that would be in their pre-qualification letter, and that's up to the borrower as far as the assets, because when you send out a pre-qualification letter, it's going to state the down payment or loan to value. Like, this borrower is approved for a conventional loan at 30 or 40% down, or whatever it may be. In that offer, if they're going above the asking price, those remaining assets could be used towards that gap or the escalation. So as far as the purchase price to the 40% down, when they go above that asking price, it might reflect more of a 20% down or a 15% down. The borrower knows how much assets they're willing to put in the deal. Okay. So when you're submitting that offer with that pre-qualification letter, that gap would be what they would want to see. Okay. They have it in that offer to
So spend. You're saying you wouldn't put an actual sentence that says buyer can cover a $20,000 appraisal gap. You're just saying you would qualify them to the full extent of loan to value.
It's going to be in the P&S regardless, because the offer is going to show that if I'm putting 40% down or $100,000, but I'm willing to go up an extra $40,000.
Understood.
It just changes that down payment from a 40% to a 20%. So the listing agent and the seller should realize that they have enough assets to absorb the difference of that gap.
Right.
Does that make sense?
It does to me.
Put comments in the pre-qualification letter. We have a comment section in our pre-qualification letter where I've been putting like A++ borrower or whatever input I can put in, but we can certainly add some stuff.
Okay, and with permission, I assume you would speak to a listing agent if the buyer gave permission.
It's funny you say that. I've actually been calling on a lot of the offers coming in, and as a matter of fact, with one of Megan's offers yesterday, I happened to talk to the agent. I've been calling the listing agents on behalf of my clients and their buyer agent, putting in just a plug in how strong they are, how fast we can get it done. If you need it done quickly, we can do that. And I know for a fact on several occasions that it was the icing on the cake.
Yeah.
That the lender actually called in one particular deal. It was a $900,000 purchase in Freeport. And basically the selling agent called the buyer agent and said, geez, nice touch having the lender call. In a close, tight situation.
Absolutely.
And they're teetering on who to choose. Again,
every little thing counts. So write that one down, folks. Kevin may, you probably wouldn't do it, without your permission, but have him put a little plug in for your buyer.
I know how tough it is. So anything that we can do to give maybe a little nudge, I mean, it all just helps.
That would be huge. All right, so I'm going to pull up definitely, again, if you guys have questions, put them out there. you know, because we want to for sure make sure we cover the stuff that those in attendance have questions about, but we've got plenty of material to cover. I'm going to share my screen here in just a second. Let's see, share screen. Here we go. So this stuff is in no particular order. I emailed out a bunch of resources this morning that some of you, you know, the most of you probably haven't even had the opportunity to look at yet. But I just pulled out a few tidbits that I thought would be of interest, and
so I'm going to
yeah.
go through these pretty quickly, and some of these
please
will,
do, Kevin. Yep.
and some of these we'll address a little bit later on. We're actually implementing what we term as Simple Nexus, which is an application, you know, on a mobile app that we can send to, that you agents can upload and put on your phone and share with your clients. It's separate than you see that number one is Guild to Go. That's actually an application that you can put on your phone. You can pick me as a loan officer or whoever, you know, that you might be using, and share leads with. And when you share that lead, it triggers us to send that borrower an application. And we put parameters on that borrower that you can see on your application. Like on there, you might say they're looking to spend $400,000, but they're $300,000 to $400,000. We can set a $300,000 to $400,000 purchase price amount. Say it's FHA with 3.5% down. We can set those parameters, and you can actually print your own, or actually save your own pre-qualification letters to send. So, you know, so as long as that borrower fits between those parameters. So that's that Guild to Go app, and that's kind of a whole separate. I've got a pamphlet here with about 8-9 pages on it, you know, but it does have a lot of information. You're updated on what the borrower is doing throughout the process. So that's something we can certainly, if you want to reach out to me after, we can go over. But we're also implementing another type of application we're coming out with this week. I haven't seen it yet, but we'll certainly send you some information on that. Obviously, we have an online link. I have a website. I have it on my email on number 2. You can certainly share that with anybody, or I know with most of you, just have me reach out to the borrowers and they submit their application online. Number 3 on the pre-approval difference, we'll talk a little about that later on. We have some things that we're implementing. You know, there's a pre-qualification and there's a pre-approval, and kind of what is the difference? And again, we'll touch base on that a little bit later. The fast track is really with the borrower's application. When they submit an online app, in that application, they can put their banking information in, like they bank with Bank of America or Bangor Savings or a credit union, and we can actually import their bank statements automated through that site by them entering their information. So that's kind of the fast track. And then depending on their employment situation, if they're at, you know, a W-2 employee at a large establishment, we can actually verify their income information automated, where they don't need to send us pay stubs because we automatically retrieve them. So that's kind of the fast track. And sometimes we're getting what's called findings that will waive. It's accepted the income that we've inputted for the borrower. So again, we can talk more about that stuff. Email updates, those are just automated. The e-close we haven't really implemented, where they're closing from home at this time. That is something that is coming down the road. And number HomeBot, that's another class in itself, where I'm trying to get with Josh and Bill to set something up to go over the agents with, because it's a whole other class for you. You know, again, this is kind of self-explanatory with the pre-qualifications, pre-approvals. You know, one thing we're going to talk about is that credit approval protection, which is going to show up in a few more slides, where basically we're going to talk about how we can approve your borrower on a to-be determined property. So they can make application, and that's kind of what I was talking about earlier. You know, a pre-qualification is when a borrower comes up. I mean, a borrower calls me up and says, yeah, I make $100,000 a year, but I'm my employer for 5 years. I have $100,000 in the bank. I have an 800 credit score. Of course, we'll pull credit, but they obviously appear pretty rock solid, and we can pre-qualify someone in a handful of minutes without actually verifying a lot of that information if we need to. The pre-approval is actually once your loan has actually gone through underwriting. That's when you've received that actual approval or conditional loan approval. The underwriter has reviewed the application and you've been pre-approved. So again, we're going to talk about where we're going to be able to pre-approve people on the on a to be determined. And if you wanted to go to the next slide, Bill, we'll come back to that stuff a little bit later.
Yeah. So, but I do have a couple of questions. I actually didn't
sure.
mean to advance. I didn't mean to advance to the next slide, but although the timing I think was just about perfect, but
yeah, that's
sort
fine.
of back on the other one, and it relates to this one. So I misunderstood. I think, and I had been sending a lot of my buyers, directly, to your website, like, to make application there first. I thought that was the most helpful to you. But when you and I were talking the other day, you said you'd rather have a phone conversation, with them first. So just have the buyer call you, or what I think is better is getting permission from the buyer to let you reach out to them and find out when the best time is to do that. Because I know sometimes buyers get busy, lazy, I would
always prefer to call the borrower if at all possible, because I get a lot of hey, I gave you a name out, they're gonna call, and I know people get busy or whatever happens. I like to touch base with people if at all possible. A lot of people have a lot of moving parts. I like to see what's going on in their lives and their employment. I had a call this morning, from someone where, the guy was self-employed for only a year and a half. His girlfriend didn't have a credit score. I mean, instead of really having them go through and submit a loan application, they're really in a position where they needed to wait. I mean, she didn't have a score. He hasn't been self-employed for, for 2 years. And I don't want to digress here, but sometimes I do. On the whole self-employment thing, if someone is in their same field, like I had a person was a hairdresser and she was employed for 5 years. If she's in the same, and she starts her own business as a hairdresser, we can go off a full 1 year tax returns as long as the income is in line on that 1 year on the self-employment as it was prior to her when she was W-2'd. So you can get away with someone being self-employed for less than 2 years. This particular borrower had only been self-employed for a year and a half. In his prior employment, he had worked at Taco Bell. Obviously, he was a general contractor now. He was at Taco Bell before. We don't have a tie on being that same line of work where we could get away with using 1 year tax return. So, I just like to talk to people to see what's going on, and if they need, if one borrower can be on the app or having two borrowers. Of course, when they submit a loan application, we're going to go through it thoroughly. We can always customize it. We will remove a borrower if need to, raise credit score on someone if we have to. But sometimes touching base with the phone conversation, it gives me a good idea on where they're at. We'll always contact them after the app.
So that's the second thing, to highlight, I think for me is, get permit, don't just give Kevin's name and number, to your buyers, get permission if you can for him to call, find out when is a good time to call, and get him the info, let him make the call. My next question sort of relates, to this. In that, what do you prefer, Kevin? Is a pre-qualification, good enough for you, and should that be good enough for us, or do you prefer that buyers submit all, see you first before they even start looking, or during the process and they get full
once we take an application and pre-qualify them, and I have an assistant, Andrew Donovan, and he's absolutely fantastic, and some of you will get to know him, and he'll be reaching out to you guys, but he's been helping me tremendously. And we are gathering docs immediately.
Okay, you are. Okay,
yeah,
good.
We are running the loan through the system. If we get that, I mentioned the fast track earlier today. Like, we can run a loan, it will waive the need for income verification or whatnot. Or they're putting their bank's information in there. If we can upload and get their bank statements, we're doing that. So we're getting everything we need as fast as we can. And sometimes we have to review someone that they're self-employed, Because a lot of these files can get pretty thick. I mean, I have people that own multiple businesses, they own multiple properties. You've got to get all the tax returns, the Schedule E's. It can take a fair amount of work to nail down the income, but we obviously reach out. We want to make sure that the borrower's in good shape, before we issue that letter.
All right, this is something I pulled out of the stuff. We probably don't need to cover it a lot. If any of you have any questions about anything we're covering today, email Kevin, call, text Kevin. He'd be happy to talk with any of you at length about any of these things. But I just pulled out some stuff that I thought was personally interesting to me that you guys might find interesting. But Guild does have the ability to co-market some stuff, and basically that they'll provide you with this stuff free of charge. So open house flyers, listing flyers, postcards. So if you're not currently doing this, here's a good way to
and we have other options available. I can send out to you guys. I mean, this is just a little sample size. If you are in need of any flyers or postcards, as Bill has mentioned, you've got a wide variety to choose from, and colors. So just let us know and give us a
look at all those colors. I know most of the agents, know what the loan types are out there. I think, one of the things, and this is going to go to, a larger, topic, for me, but I don't ever think agents should try to be lenders, or try to pre-qualify buyers. I mean, they teach us that stuff in licensing school. I mean, when I first got in the business 25 years ago, I was making my bread and butter on the Coldwell Banker office across the street. That was, they were so old school, like they were trying to qualify buyers themselves and telling buyers they couldn't buy. And then they'd come across the street and I'd send them directly to a lender, who could get them qualified. I mean, sometimes the less the better off you are. So, I mean, I'm not saying it doesn't, as an agent, you shouldn't try to keep up a little bit on what rates are or what programs are, but like Kevin said about the self-employment, gee, maybe they can do, 1 year. And here we all thought, the 2-year rule still applied. So, always just get these buyers in touch with Kevin as quick as you can. Credit score requirements are constantly changing. It looks to me like they're getting a lot lower, than they were. Jumbo loans had gone away, for the longest time. I think Kevin can confirm if I'm right, but I think after the last market
well, there's with the rise in prices, we're seeing a lot more jumbo loans now. I mean, the conforming mortgage loan amount is $648,000, right around 648, 650. They're raising it every year, but as you know,
those are jumbo loans. I was thinking of bridge loans. That's the one. Those
we're not offering bridge loans, and I should have. The bridge loans are not available in the state of Maine as of yet.
Okay.
They are working on that, but we are not currently doing bridge loans.
Gotcha.
We are in other states. I'm told that has to do with more the state of Maine than us. So
yeah, most buyers are pretty nervous about doing that anyway. So, but some of these credit score requirements now, I mean, those have come down a lot in the past couple of years, right?
Well, one thing about Guild is we're one of the largest lenders in the country. J.D. Power award winner, #1. We service 95% of our loans. Okay, the only loans that we do not service are jumbo and like state housing authority loans, Maine state housing.
Okay, so let me get that point straight. So a buyer, if a buyer gets a loan with Guild, they don't have to worry about it getting sold?
Correct. We serve my name and contact information, phone number, my whole is on every mortgage statement they receive.
That's huge, because that's the excuse.
I'm sorry?
Oh, that's the excuse. Some buyers want to work with, Gorham Savings or, some local bank that's not going to do as good of a job because, they don't want their loan to be sold. So that's huge. I think.
I mean, with RMS, I mean, we held some loans, we sold a lot of loans. Not the case with Guild. They hold not anything conforming, VA, FHA, rural development is all held unless that borrower sells that, refinances down the road at some point, it's held by us. So when we sell direct to Fannie and Freddie, we're not a broker shop. Okay, everything's direct. Everything's done in-house. We underwrite and process right here. We fund our loans. You know, like we go down to, you know, we go down to FHA as low as 540 with VA. It is a 10% down requirement below a 580. You know, as a matter of fact, I have a loan right now. I'm dealing with one of the agents at Maine Real Estate Experts where, you know, one of the borrowers is a 544 and the husband's a 603. They sold a home and they had like $75,000 in the bank, and now they are under contract with an FHA loan, putting 10% down. You know, so, you know, you got conventional financing and government financing. A couple of notes on what you're seeing here is the alternative options. We have the down payment assistance, which, in case you guys, you know, Maine State Housing is still out there with a $3,500 grant. Their rates are currently 2.875% still today. So if anybody has a first-time home buyer and they fit within Maine State Housing's guidelines on income and whatnot, I mean, you still get under 3% rate. Freddie Mac, another thing that we do that our competitors do not, and this is important, because people don't know how it actually works when someone gets pre-qualified. It's, you know, you put the information in the system, you run the loan through the computer, but all our competitors, most of them only use Fannie Mae, which is DU, Desktop Underwriter. We run a loan through the system using Fannie Mae and Freddie. We run it through both. I might get a denial with Fannie and an approval with Freddie. I might get a property inspection waiver with Fannie, but not with Freddie. If you put 20% down conventional, so we have the, you know, we're fortunate that we can run it through both Fannie and Freddie. I know that doesn't mean much to you guys hearing it on, because you don't see what I'm involved with every day, but it is big. And Freddie actually, on first-time home buyers right now with 3% down, have implemented, depending on your medium income on the first-time home buyer, because I don't want to get too much, you know, into that stuff with you. But if they're eligible for first-time home buyer, 3% down, they get up to a $2,500 grant towards closing fees. I'm doing one right now where they're eligible for $1,000. So these are some of the down payment assistance stuff we have. We also do manufactured homes, double wides and single wides. We do them with government and conventional. So those 5% down. I believe we're actually doing a little 3% down now with mobile homes. And we also have a doctor loan program. If anybody has a client who's a doctor, it's a 0% down. So anyways, we can.
Yeah, April just asked a question. What percentage of buyers are pre-approved versus pre-qualified? I don't know if that's.
Well, that's going to change. I mean, that's as far as when you say that, and we're going to go to the next slides because we kind of just implemented this. We actually just started getting emails on this a few weeks ago on the actual pre-approval. So as of right now, most are all pre-qualified, but going forward, new people coming in, they will be getting pre-approved.
I mean, they all start out as pre-qualified essentially, right? And then as you start pulling in documents.
The rule of thumb is you pre-qualify, we get all docs in. I mean, as loan officers and my assistants, we know, but then we typically would not submit the application until they went under contract. Right. Now we have a purchase and sales agreement. Now we have a property address. Now we have a purchase price. Now we have an application. Right. Now once we trigger that application and put that property address in the purchase price, that triggers that loan for disclosing. And you probably heard the buzzword RESPA and disclosing and the federal guidelines on that. We have to disclose that loan within 72 hours. It gets emailed to the borrower and they DocuSign it. Then we have all the documents and we send it all to processing and underwriting. And then within 7 or 10 days, we get the conditional loan approval from underwriting. Then you're technically at that pre-approval stage. But what we're going to start doing, and again, we're going to see it in a couple of slides, is we'll be submitting these loans to underwriting without having them being under contract. It'll be a TBD property with parameters in there set as far as what they're looking to spend in down payment. Does that answer your question?
I think so. I mean, I think that's what most of us are used to, is that lenders didn't want to pre-approve until we had a purchase and sale. But you're saying that's going to change, and now we're going to get, because that would give a buyer an advantage, I think, over buyers who are only pre-qualified. If our buyers are pre-approved, that's going to give a little more confidence, I think.
Yeah, and in the comments section or in our letter, it'll be a pre-approval letter, and we will note that letter that this borrower has already gone through underwriting. And again, we're going to touch base on that in a few more slides.
So again, and April, feel free to unmute yourself if I'm not explaining your question right. So how would my seller give one pre-qual over another if they are looking at several offers? I think probably she's looking at, wanting to know how do you give preference to one over another? And I think, that's where it comes in. I've had to tell some agents, they're dealing, with out-of-state lenders, online lenders. If I'm a listing agent and I've got multiple offers on a property, and, I think what agents have to know is they think the highest offer, always wins. And while that's true, that doesn't mean that the highest offer started out as the highest offer. A good listing agent is looking at all the terms and saying, okay, Mr. and Mrs. Seller, this is our fourth best offer, but the top three are without estate lenders, or whatever the case may be. Let's see if we can make this fourth best offer that's with a good local company. I know the loan officer, I know the company, they're good. Let's counter that one at the highest price and see if we can turn that into our best offer. So I don't know if does that answer your question, April, as far as I think an actual, some lenders I've seen their letters say pre-approval, but it's not really a pre-approval, or it says pre-qualified, but they haven't even actually pulled credit. Whereas I know Kevin, historically, even with RMS, you're asking a lot of deep probing questions. You're looking at tax returns and, stuff like that, pay stubs, finding out they really don't have as much overtime as they said they did, or, whatever the case might be.
And you have to, when you've been through, you've seen so much different, stuff going on with people, and so much you have to look for.
Sure. Well, before we move on from this slide, I shared this slide just because I thought it was an easy, there might be some stuff in here.
This is a great template and a great tool,
It
as
is.
far as where, the different minimum credit score requirements, the down payment, the seller concessions, what you're allowed. And then, with people, and I get calls all the time, people have gone through bankruptcies. What's the wait limit? How long do we have to wait before we can purchase again? And
that's come down a lot over the years, I think.
It has a little bit, but it depends on the type of bankruptcy. It's a Chapter 13 or a Chapter 7, if they made on-time payments, if they're in a Chapter 13. So that we have to look at a lot of that stuff.
Yeah. Did I hear recently that is medical stuff getting ready to come off credit reports, or is that not quite as broad as I heard?
I have not seen medical collections come off credit reports. We're still seeing them.
Okay, I thought I heard something was getting passed in Congress where the credit reporting agencies were going to take that off. I know that would help a lot of people.
Well, there's a lot of things coming down the pike, along with desktop appraisals. We're supposed to be seeing them. That would be great. Not have to rely on what's going on in the appraisal world right now, as you guys know.
Is that the same as the inspection waiver you mentioned before?
That would be the property inspection waiver. That is the same. And we are seeing.
And how does that work? Who can get one of those? Do you need is it based on the borrower or the property, or both? Like how can an agent know if they can?
Property. It's the property.
It's the property. Okay.
It has all to do with the property, the address. When you run these loans through what we term as automated underwriting, you're running the loan through Fannie and Freddie. And I mentioned we run it through both, where a lot of our competitors are just running it through one. If that person had a loan on that home in the past 5 to 10 years, and they have a conventional loan that is with Fannie or Freddie, that is in their system. So they pick up on that address because they have information for that on that property, because that person had a loan on it at some time. And it was, that's why if I can look at a credit report and it'll say if someone has a mortgage on their credit report, it will tell me conforming mortgage Freddie Mac or Fannie Mae. So I know I have a good chance of running that loan through, or say they're doing a refinance. We see them a lot on refis, obviously. I can run it through Freddie and more than likely get a PIW, which we term as a property inspection waiver. We've accepted the value on this property. Right. Now, there's been cases where, though we don't like to do it, where we'll trigger the application, because when a borrower's putting an offer in, it's just an offer at that point. they're not under contract. But in order to find out if that property gets a property inspection waiver, you actually have to put the property address in the system. Once you do that, you've disclosed an application. So if they
Okay.
don't go under contract, we actually have to withdraw that application, do a new one.
Gotcha.
Banks don't like to do that.
No.
They do. And so once we put that property address in, we can fish that system. And I did it with Josh a few months back, where he was putting an offer in and the listing agent wanted to know if we got a property inspection waiver. At $550 purchase price, I didn't get it. I started fishing and putting different purchase amounts in there. And at $536,000, I got a PIW.
Huh.
Which at $537, I did not. Accepted because they were going over asking price. So I can't recall what they're asking, but we're 30, 40,000 over asking. And it accepted a certain amount. They ended up going under contract because they told on that offer, hey, this lender has a PIW at $536,000. You want to accept our offer? And they took it. They
Now,
knew
it does have to be a 20% down buyer, correct?
does have to be 20%
Okay.
down.
Okay.
Because under less than 20% requires mortgage insurance, PMI, some form of PMI. So you won't get that PIW with less than 20.
Gotcha. All right. I'm going to go to the next slide if I can. I don't know how much you want to talk about this or.
So this is our extended builder rate lock program. I mean, I'll tell you, if I was building a house right now, I don't know if I'd want to know where, take a chance on where rates are going to be 9, 12 months from now when my house is done.
Right.
Because just today we had an alert to lock. I mean, the Federal Reserve Governor, Lael Brainard, every time she opens her mouth, rates go up, and she's mentioned today that, we're going to be aggressive with rate hikes, and we had a relock, a reprice, I should say. So hopefully we just don't get too out of control with rates. I mean, we're all hoping for that, but we can, if someone's building a home today, we can lock their new construction loan in for as much as 12 months down the road. We can do a 6-month, 9-month, or 12-month rate lock. Certainly it comes at a premium. There is a price for it. There are some guidelines around it. There is a 0.5% lock-in fee. If your loan's $400,000, we have to collect $2,000 when we do lock it in. It goes towards down payment or closing fees. However, it is a non-refundable lock-in fee. So if for some reason they don't, who's going to build a house and not end up buying it? I mean, God forbid they don't, everything works out, they don't lose their job or whatnot. But and there is a premium as far as the cost, but that I just locked one in a couple of weeks ago, but the premium is far less than what people might be looking at for rates, 6, 9, 12 months from now. So that's something we can do. We can lock in those deals as much as a year in advance.
And it's almost not a fee if it's going to go towards their closing costs or down payment, as long as they close. So
exactly. If for some reason they decide not to, then they would lose that money. But it does go towards that. This is what I was talking about earlier, the credit approval protection. So this is when we can send your client's application into underwriting on a TBD property, and get them all pre-approved. So if we're unable to close the transactions, for some reason, something happens, obviously the borrower loses their job. There are some guidelines. If something happens through no fault of our own, then this wouldn't apply. However, we'll pay $1,000 towards inspections, appraisal, and relocation cost, and we'll even pay lost earnest money deposit up to $5,000. So this is again where we take submit an application on a TBD, collect all the documents. They then go under contract whenever 2, 3, 4, 5, 6 weeks later. If for some reason they don't close, we do have some insurance that we offer.
That's excellent. I'll skip the fine print, but I did email that out to everyone if you want to read that later.
Yeah. So this home buyer express guarantee. This goes with the credit approval protection guarantee. It also includes a $500 closing cost guarantee. We'll be ready to close your client's loan within 17 days of that purchase and sales. Within 17 days of that purchase and sales agreement, assuming appraisal is in, if there's an appraisal required, we'll give them $500 towards their closing fees if they're not cleared to close 17 days before that contract date.
Lock and
The
shop.
lock and shop, this is, this kind of coincides with the extended builder rate lock program. I can actually lock a borrower today on a home that I'm under contract with. So I can lock a borrower today for 90 days on a to be determined borrower. In today's market, I'm not seeing too many people take advantage of it because it's been so hard to get something under contract because it is only a 90-day rate lock. So there is a $500 fee, again, that goes towards down payment or closing fees, but again, is non-refundable. And it's a 90-day lock today. So if they find a home in the next 45 days or so and they're under contract, again, that lock will expire in 90 days. We can do extensions and stuff like that, but if someone's concerned about the market and where rates are heading and they feel comfortable they're going to be going under contract, this is something you might want to take advantage of before rates get worse, is to lock something in. And then again, when we get to P&S, we'll start the application.
Or the fine print.
The thing with these, I want to say one thing with the extended builder rate lock program and this lock and shop. They allowed a one-time float down within 30 days of closing. So if rates get better and we're within 30 days of that close date, but we can't be within 15 days of the close date. So you actually have a 2-week window. You got a 15-day window within, that day 15 to day 30 of that close date. If rates are happen to be better than when we locked them in at, we can float them down free.
Very good. Come on. Now let's see what's going on here. Oh, maybe that was the last.
Yeah, I think that's the last one.
All right. Well, that's good. I have some questions. I don't know if anyone else has any. Welcome to throw them in the chat, but let me pull up what I had. See what I got here. Talk about mortgage insurance a little bit. I know we probably have a lot of agents. I'm guessing the refis have dried up, possibly. I know that was one way people could get out of mortgage insurance if their house had gone up in value. But as a service to our past clients and that sort of thing, if they have mortgage insurance, what kind of loans do they need to get a new appraisal? Are there any kind of loans where they can document that home increase, price or value increase some other way and get out of mortgage insurance, or how does that work?
Well, anytime you have PMI, you're going to have mortgage insurance for a minimum of 12 months, period. Unless you pay your home off, the lender, ourselves included, is not going to remove that PMI. So, after 12 months, it all boils down, when people buy a home and they put 5% down, 10% down, they get a minimum payment, they get an amortization schedule at closing. On that, it outlines all the payments for the next 30 years. It's going to tell them when that PMI is going to drop off. It'll tell them the month and the year by making the minimum monthly payment. So obviously by applying more towards principal, towards that payment, you get to that number quicker. But PMI doesn't automatically drop off until they hit 78% loan to value. Not 80, it's 7.
Based on the original mortgage.
Based on the original mortgage.
But I'm saying with values going up so high, so pretty much in every case, is a buyer going to have to, an owner going to have to go get a new appraisal to prove that, or?
Yeah, for the most part, they after 1 year, they would have to call us or whoever their investor is, and that's going to be case by case, and more than likely they will want them to supply an appraised value. I personally, I think, if someone's at I don't know if people are going to have much luck doing that. It really depends on how long they've owned the home, how long they've been paying PMI, and how much their value's gone up. But I guess they would need to contact their investor and and
Yeah,
go through
I
that
know
process.
refinancing was a great, option before, but probably not so much right now.
Not
So,
easy just to, the banks out, and I can't speak for all the banks out there. There's a million of them, but but it's not easy for them they don't like to remove mortgage insurance. It's a protection form.
yeah, sure, sure. All right. Let's see. So what are you seeing? You see a lot of offers. I mean, what are some common elements that you're seeing in the offers that are winning as far as, how much earnest money are they offering? How much are they offering to cover an appraisal gap? Is 10,000? I mean, again, I don't know if it was correct. I told an agent yesterday that I wasn't seeing a lot of people going over 10,000, over a 10,000 gap, but maybe that's old information.
I've seen some doozies, I mean, I had one yesterday where uh, I know that the highest offer was a VA offer by a
Okay.
landslide by $25,000, and they were picking up a appraisal gap. But from what I understand, the seller had some concerns with the property as far as some peeling paint and and they didn't want to deal with it. Unfortunately, as we all know, it's been tough for the government, the VAs. Even though I've got a bunch going and they got to hang in there and keep putting their offers in. But from a seller perspective, they have been known to shy away from that and not wanting to they just, so they're leaning towards more of the conventional offers, because nobody wants to fix anything. So in earlier when you were referencing, I mean, you're absolutely correct. The highest offer does not always win. And in this particular case, the highest offer was significantly higher.
And they didn't go with it because it was VA.
They didn't go with VA because they didn't want to deal with painting anything.
And well, that's gonna relate to another question I had earlier. What's the worst kind of loan? I didn't think when I hear paint, I think FHA is the one that's real picky with paint. Is VA picky with paint too? I mean, what's the loan type?
Yeah, VA follows the same guidelines as FHA when
They
it comes
do.
to
Okay.
safety concerns.
Okay.
Yeah, even rural development. And I actually have something I can email you out, Bill, that you can send out. It actually goes over what the appraisers are looking for as
Okay,
far
that
as
would be super
safety
helpful.
requirements. Because I had one that I hadn't had before earlier this year where it was a crawl space issue in the basement. And who would have given thought of even, a crawl space in the basement? But the appraiser did. And the crawl space was less than, I think it was 16 inches. So if it's less than 16 inches and you have components in that crawl space, in this situation, they had heating elements and components in that space that you couldn't access.
Yeah.
Because there was too shallow. And so we've hoped to find a way. The borrower couldn't do anything but FHA and ended up the sellers, to excavate and do what they needed to do to try to get at that. But if you think about it, I mean, do you want to buy a house with these elements and components in an area you can't access? So, and that's protection that some of these FHA and these government loans have for people, where conventional, it would.
So let me ask you what might be a dumb question, but I've seen this sometimes, especially with VA loans, because a former service member, they're eligible for that, so they want to use it, because they're eligible, but it isn't often the best loan for them, and sometimes they qualify for something else. I mean, you're telling me a VA buyer was willing to cover an appraisal gap. Well, that tells me they probably could have done another kind of loan, maybe.
So the offer that I was not the lender on this particular deal.
Okay.
So I was getting this information.
Oh, secondhand.
From the agent.
Yeah.
On what the offers were and what they accepted. So, I can't say, yeah, you're right. Why would they want to pick up an appraisal gap? The thing with interest rates, the thing with government loans, your interest rates, they run as much as a half point better than conventional.
Okay, so that's one reason why they might want to go VA.
Oh, VA hands down is an awesome. It's the best loan program out there. You could do 100% financing and have no monthly PMI. you know?
Right, but you're not gonna win in a multiple offer situation for the
No,
reasons
that's
we've
the
already
problem,
talked
but
about. I mean,
but as
that's the
far as
problem.
their payment is concerned,
Yeah,
and I have VA borrowers now that have switched to conventional. And,
right,
doing five, they don't want to, but they're finding, they realize they kind of have to.
right.
But, one of the agents in the Gorham office, they got a VA borrower under contract. I guess it really depends on the house, the office, and the competition you're running up against. I mean, it's all who knows. I just tell people, put your best offer in that you can. If it doesn't work out, all you can do is go on to the next one and try not to, I know it's been tough for a lot of people. A lot of people have been doing it for months now. The best offers are the cleanest offers. I mean, that's what the highest and the cleanest,
Yeah. Megan's got a good question. She says, if someone's using a VA loan with 100% financing, are closing costs rolled into the financing, or do the buyers pay closing costs out of pocket? And I think I know the answer. I think it depends on the appraisal, right? If
No, you can't roll closing fees in on a VA loan.
you
Nope,
can't,
no.
that's out of the seller can pay them.
You can sell it. The only way you can get, sellers rolled into your loan per se is ask the seller to pay seller concessions. In that
Okay.
prior slide, it showed the FHA and the VA, and it actually had amount of seller concessions where you can actually you can ask up to 6% seller concessions. You wouldn't need 6% of it, but if someone's doing a VA loan where they literally have little to no funds, they're gonna have to go in with that offer and asking the seller to pay their closing fees, or they are responsible to pay them.
Okay.
VA, with Maine State Housing, they had that Salute Maine program, and I encourage anybody to Google Maine State Housing. If you're not familiar with Maine State Housing Authority, Misha, you can get all kinds of information. They have the Maine Salute with your VA. You can get interest rate, is it 2.6, 2.7 right now?
Wow.
30-year fixed, you can get a $3,500 grant towards closing fees. One thing about the grant with Maine State Housing, even though if you're VA or RD where there's no money down loans, is the borrower has to have 1% of their own funds in the deal. So you have to have a little skin in the game, 1%. And that's something that's often missed with offers where someone's doing, someone will do an RD loan and they get the seller to pay all their closing fees. That's not going to work with Misha RD.
Right. And maybe, that's a perfect situation, I think, where if the agent asks you to make a phone call, maybe that VA buyer, yeah, they could do conventional, they could do whatever, but that VA loan is saving them a ton of money, and maybe that listing agent just needs to be reassured that, hey, this is a great borrower. They just happen to be qualified for VA, and it's a way better program, for them. So don't hold that against them.
It's been easiest. It's been very tough.
Yeah, I know it's easier said than done, but
it's
not a lot of lenders are calling, on behalf of their borrowers. So, I mean, I think that that's huge. And as a listing agent, I would feel pretty comfortable with that. So, I don't know if you can answer this one or not. And Andrew's asking, my uncle just passed away. Condolences, Andrew.
Sorry
and
to
he
hear
had a
that,
reverse mortgage. My cousin is the executor and going to be selling his house. Pay the amount owed at closing. Is it that easy? I think.
Well, I haven't been through that, and I don't personally do reverse mortgages. We do reverse mortgages at our company. We have dedicated LOs to handle them. And I do know because my mom has a reverse mortgage. And I know that she can refinance or sell the home. Like any loan, they'll just put in those, any funds owed to the bank, back in the payoff.
Right.
When you refinance or sell your home. I can't imagine that it would be that difficult.
Yeah, it is similar. You want to make sure they don't obviously fall into, foreclosure or something like that, that the payment's still being made. But otherwise, my understanding that, works just like a regular loan, and it can just, like Kevin
whoever's
said,
the executor, the cousin should be calling or finding or trying to get some authorization to find out what the payoff is on that home.
Yeah,
And,
just
I
pay
think
it
as
off
long
like
as long as you get a payoff, someone buys it, you know what it is. Title company's going to do their thing, and it'll all work out in the end.
Well, I covered all of my questions. And it's been about an hour. So thank you, Kevin, for being here today. Like I said, if you aren't already working with Kevin, glad you joined us today. He is one of the best. No one will work harder than he does to get your buyers approved. So reach out to him, give him a shot, and
Yeah,
thank you, Kevin.
just call if you have any questions, or, you know, that's, and the more you know, it makes you, you know, you're going to be a stronger agent in front of your clients. You know, the more knowledgeable you are about some of this stuff and knowing some of these loan options, you know, when you're speaking to somebody.
One more bonus question. Mary's asking, is there a certain amount of time that needs to pass between having an original mortgage and refinancing?
Technically, no. You can refinance immediately after you get a new loan, assuming, but I can tell you from a commissioned loan officer that if I do a loan for somebody and is paid off prior to them making 6 payments, they call that early payment default, and any commission that that loan officer or lender received needs to be paid back.
So not good for you.
Not good for me when that happens.
Yeah,
20
and of
years,
course,
it's happened twice. I did a refi for somebody. I think the only reason they did it, they wanted to do cash out, and they put their home on the market and sold it. So it was paid off in like 3 months.
yeah, and as an agent, you know, we're in the position sometimes to help people. You know, it's fairly easy to calculate the difference in their payment, you know, do the math, you know, figure out their closing costs. And, you know, if it's going to take them 6 years to recover, you know, the cost of refinancing, and they don't plan on owning that home but for 3 or 4 more years, then, you know, it might not be you know, worth doing. You know, if they're going to be in it a while, or they can get rid of mortgage insurance. I mean, right now with rates rising, you're probably not going to see a lot of people doing that. So well, second bonus question, that's fine. We'll stay online as long as the questions come. Megan's asking, she heard that certain loans won't work with a driven point well. What loans prohibit this? Is that a problem for some type of loans, Kev?
Well, you know, and this kind of, some of this stuff goes back to what the appraiser says. You know, the appraisal is an extremely important, huge piece of anybody getting a home loan. There's good appraisers. Sometimes there's not so good appraisers. There's some that nitpick on some stuff, and the verbiage they use in their report, because I'll tell you, when underwriters, it's all about that verbiage. When borrowers are writing letters, you know, in the appraisal report, but what they're going to want to know, first of all, conventional financing, it should be fine. But if the appraiser says it's common for the area, you know, if it's common for the area, it's okay. I know with rural development and FHA, they want the driven point wells. I believe it's 20 feet outside the foundation of the home. What happens with a lot of these driven point wells, and I'm not sure Megan can answer here, is that they're in the basement.
Yeah, sometimes they do that.
And they're in the, and that can be an issue with some of the government financings,
right,
you know, specifically. So it depends.
I've never seen a problem with them as long as they were outside the home and
right.
You know,
outside the home and they're common for the area. That's what the appraiser usually states. Then that's fine.
Yeah. Well, I'll look forward to that. You said you had an appraisal issue.
I do. I don't know if it references driven point wells, but I certainly have guidelines on wells that I can send you. I had Josh was sending an email a couple of weeks back on, he had a buyer, it was buyer was listing, I can't recall, it was a listing. So it was another buyer going through another bank, and they wanted a water test for FHA. Now, water tests are not required for FHA unless the appraiser notices an issue with the water, or a smell, or an odor, or it's near a landfill or something like that. So he actually had asked me and someone to, which I sent a couple emails, you know, but we have our guidelines that actually basically states that the only reason that we would require a water test for FHA is if the appraiser noted that there was a concern there. Other than that, it's not required. So, but you will find some, I don't know if it's out-of-state lenders, because a lot of your broker shops, who knows who they're using, or out-of-state banks, there's what they call investor overlays.
They can set a higher standard than what
they still may want one. you know, anyways.
Yeah.
Well, thanks,
thanks
everybody,
again.
and please don't hesitate to reach out, you know, at any time if you need any help.
All right. Thanks everyone for attending. Have a great day.
All right, bye-bye.
See y'all.
Thanks, Bill.
Thank you, Kev.